Greetings, my name is Daniel DeGraff Reed, and we have here today a mini case study about adjusting entry and actions taken to improve financial forecasting. Now, let me give you a little background about what is going on here. The manager of the purchasing department by the name of Parsi is responsible for financial forecast. And unfortunately, Parsi's forecast for the last quarter was off by a very large margin. Now, this is what we all have to understand. A physical inventory count was conducted at the end of the quarter that determined $350,000 of a material used for insulation was considered missing. So it was missing inventory in action. Now, this triggered the company's accounting department to create an adjusting journal entry. Now, throughout the presentation, you will hear me talk about how inventory transactions are related to cost of goods sold and the process for recording material costs and how that normally works. And you will see how that correlates to the adjusted journal entry and suggestions on how we can avoid this for the future. Enjoy. Greetings, my name is David DeGraff Reed, and we have here today a mini case study about adjusting entry and actions taken to improve financial forecasting. Below is a typical journal entry of cost of goods sold. Now I'd like to explain how inventory transactions are related to cost of goods sold. Please understand this. Inventory is goods that are ready for sale and is shown as assets in the balance sheet. When that inventory is sold, it becomes an expense, and we call that expense cost of goods sold. Inventory is the cost of goods which we have to purchase for resale. Once this inventory is sold, it becomes the cost of goods sold, and the cost of goods sold is an expense. Now we move into measuring and recording material costs. Now, we look at the bill of materials, and the bill of materials is a document that lists the type and quantity of direct materials required to manufacture a standard product. But companies using job order costing systems frequently receive orders that require customization in design, size, color, etc., all that good stuff. In situations like this, the bill of materials cannot be used to determine the type of quantity of materials required to complete a specific job or order that a company may receive. Therefore, the production department determines materials requirement using the information provided by the customers. The inventory report, which was the result of an inventory count that happened in the last quarter for the company in the case study, triggered the company's accounting department to create the adjusted journal entry we see here. Now, Parsi, the financial purchasing department manager, is solely responsible for financial forecast. But his forecast in the last quarter was off by a large margin. In fact, that margin was $350,000. So it looks like the inventory was at a loss. But what we have to understand is that inventory fluctuations can wreak havoc on more than just your stock room. When recorded inventory levels are lower than actual inventory counts, the cost of goods sold rises artificially. Conversely, when actual inventory levels are lower than those recorded, the inverse happens and cost of goods sold is artificially lowered. Now, in this case, when they did the inventory count, the count was actually lower than what Parsi forecasted. In both cases, the adjusting entries are necessary to reflect the true state of affairs. So, this happened to reflect the true state of the affairs. Now, there's no telling how much of the actual material was used in creating the refrigerators, but there was a loss of inventory and it resulted in the adjusted journal entry. In an effort to bring all this together and to create a sense of clarity, I want to give a few suggestions on how this can be avoided for next time. So, the first suggestion is to track all items by location. Now, in the manufacturing setting, the final way to prevent inventory errors is, instead of organizing inventory by type and manually organizing each time a new item is stocked, organize items by location so that there is no reorganization required. That way, you know that the items are where they should be, and when parts or items are put together or manufactured, you know which ones are being used. The next thing I want to suggest is to label the items. Make sure all items are labeled correctly. This may sound like a given, but you'd be surprised how often manufacturing places do not label their items with barcodes or written labels. This just keeps track and correct these issues as they are stocked or picked. No matter how rushed you may be, it's worth the time to fix so it can avoid the errors for next time. In an effort to bring all this together and to create a sense